Today we're going to go over how to sell or refinance. I'm kparker, Equity One Lending. And I'm with
I'm Kim McBride.
All right, so to give everybody a chance to get locked in. Second, all right, so people coming in. Cool. All right, so we're going to get started momentarily. So we're going to talk about how to sell or refinance amidst the COVID-19. Kim, this is your show. I'm not going to.
Oh, no. Give me 1 second. I'm going to try to share this to my page. This is our show. I can't be a great realtor without a good lender. This is our show. Okay.
All right, I'm back. All right. So yeah, people are tuning in to see people coming in now, and we'll bring up some of the details. All right. So.
Okay. Let's see if I have my pen.
All right. Do you want to go over anything, your contact information, anything like that, or?
Sure, I can do that. So, good evening, everyone. I'm Kim McBride with Apex Realty. I am licensed in the state of Maryland, pending Pennsylvania licensure. I can be reached on all social media platforms. On Instagram, it's at getkeyswithkim. On Facebook, it's Kim McBride. On LinkedIn, it's Kim McBride. It's Kim McBride and Get Keys with Kim. So you can pretty much find me anywhere. As far as phone number, 410-961-2742. And my email address is getkeyswithkim@gmail.com.
All right, I'm kparker. You can reach me or with Equity One Lending. We're at www.equity1spelledout.lending.com. And you can follow me on social media. Follow the company at Equity One Lending on all social media platforms. You can follow me at kparker. So yes, we want to try to get into the topics. We're giving people a chance. People are coming in. With people on Facebook, YouTube. And by the way, we want to make sure we put some comments up or put some information up on the screen. If people are trying to ask questions or get in touch with us or try to forward the questions, please do so in the chat section on Equity One Lending Facebook page, and they'll pop up during the Q&A. At the end, we're going to pick some of the questions in the Q&A section, and we're going to actually address those directly. So we can give you some answers on what to do. It's a lot of questions about what to do as far as mortgage forbearance, the home buying process, the home selling process, and you have experts here to answer your questions. So, yep, more people coming in. Questions are coming in already. Got it. So that's good. Let's try to wait. And by the way, Kim, the monitor up here on the screen is just one of the forums. We're on Facebook and YouTube, and we got watch parties, so we won't get the real count until after this is wrapped up.
Okay.
All right. So let's get started. So you had a few questions, Kim. You're gonna start off, obviously.
Sure. So as a real estate agent, I come in contact with not only investors, but people looking to sell property and purchase property. And previously, Quay and I were able to connect last month to do a live broadcast for those interested in credit repair and purchasing in the future and what COVID looked like for them as future homeowners. But then my sellers reached out to me, and they were just as interested in trying to get information about what they could do to either prepare to refinance or possibly discuss things like mortgage forbearance or even options of selling. So most people are like, is it a good time to sell? I was thinking of selling, but I wasn't sure where to start. And so what better way to get some of your questions answered than for me to join forces with Quay to provide you with those answers this evening. So we're going to go through all of that and probably then some. So again, as Quay stated, please feel free to drop some questions in the question box, and we'll make sure that we cover all of them in the Q&A. And if for some reason we're not able to answer all the questions this evening, we will leave our contact information again, and you can feel free to contact us to get your questions answered. So,
all right.
I guess we can start with our first question. Go ahead, Quay. You take this one away. The mortgage is your arena.
All right.
It's all you.
So the first question is, what is a mortgage forbearance? A mortgage forbearance is essentially when, in lieu of making a payment, the lender agrees to allow the borrower to put the payments either to defer the payments either to the end of the loan or to a later date. that can operate in one of two ways. And we're going to talk about what's happening in the pandemic. Under the CARE Act, there was an announcement that mortgage companies would allow borrowers to basically go without making mortgage payments for anywhere between 90 days up to a year if they're impacted by COVID-19. Ironically, before that announcement was made, there weren't some considerations such as the first, the government's not loaning the money. These are private institutions. That's your 401ks, your investors, private investors, people putting their money in the market. So what does a forbearance look like in many cases? It looks like the people who are waiting their money are either not going to get it or it's prolonged for an indefinite period of time, which is a big problem. So the mortgage industry, or until recently, Fannie and Freddie released something in FHA stating that the forbearance process, the money is being repaid, but on FHA, Fannie Mae, and Freddie Mac mortgages and VA, any government insured mortgage, essentially that forbearance period, the mortgage, those mortgage payments are going to be payable at the end of the loan term versus it being due in 90 days. Now, the bad news is for people who have a uninsured or non-conventional or unconventional mortgage that's not Fannie, Freddie, FHA, or VA insured. The option of how to reconcile any forbearance is totally up to the lender. And a lot of people are surprisingly saying they're going to wait or they're going to collect in full after 90 days, the full amounts payable and due. They're not willing to wait until the end of the loan term, which could be anywhere from any period of time up to 30 years from now, depending on people who just purchased. So that's basically how mortgage forbearances work and what a forbearance is. The impact, we'll go into that later. Does that answer the question, Kim?
It answers the question. So let me ask you a follow-up question if I can. So for those who are listening that say, I'm interested in a forbearance, it's not necessarily the government's decision as to whether that forbearance is granted. It's based on lender to lender qualifications.
All right. When a mortgage is FHA, VA, like I said, government insured, the CARE Act does have the authority to stipulate how the forbearance works. So with mortgages that are FHA, VA, or Fannie, Freddie insured, yes, the lender is forced into a forbearance situation where they can do it. So it's important to know what kind of loan you have if you're in a hardship. And I'm not painting the picture that forbearance is the way to go. I'll explain the ramifications later. We'll get to that question. But it's not totally up to the lender when you're a government insured. It's part of the act because these loans are insured by HUD or Fannie and Freddie, which are quasi-government agencies. So they have to conform to the CARE Act if the loans are government insured. But a lot of people are mistakenly thinking that their loans are insured and they're not. A lot of loans people are calling about are not conforming loans. They're just standard traditional loans issued by a bank, and they're not covered under the CARE Act in that manner as far as the long-term forbearance.
So how does a homeowner know if their loan is insured?
You would have to check. The first thing is you could contact a mortgage company. They could tell you, but there are tools online where you can look up on Fannie Mae and Freddie Mac's website to look up if your loan is Fannie, Freddie insured, or you can look at your mortgage instruments and mainly your note. It will tell you typically what kind of loan you have. If it's FHA, there'll be a case number associated with it. Same with VA. There'll be a number associated with it, an insurance number to know that it's VA, FHA, USDA, or Fannie, Freddie. Fannie and Freddie you have to look up online, but FHA, VA, and USDA, it's pretty obvious on your mortgage note.
So do they have to contact their current lender or can they contact any lender?
When you're talking about forbearance, you have to contact your lender. But before we go too far with that, we kind of want to, we talked about which mortgages are covered, and we talked about the Fannie, Freddie, VA, FHA, USDA products. But I want to talk about the options available outside of a forbearance, because I'm going to go into the drawbacks of a forbearance momentarily. But the options, one thing that people miss is you have the opportunity to refinance right now. Interest rates are at historic lows. Typically, the stock market, or should I say the mortgage markets, respond inversely to the stock markets and everything. So right now, this is a good time. It might be a bad time to have money in the stock market. It's a great time. I'm not going to correct that. It's a bad time if you've had money in the stock market, not a bad time to buy. But if you are from a mortgage side, it's a great time to take advantage of low interest rates if you can qualify for a mortgage. And that's where a lot of people are missing it. Yes, you may skip a mortgage payment or two, or even a few mortgage payments, but that money has to be repaid. But over the next X amount of years, you're going to be stuck at a higher mortgage payment. So you have to weigh the pros and the cons. Would you be better off paying your mortgage and taking advantage of the lowest interest rates historically, or doing a forbearance and being stuck where you are? It's kind of a catch-22, and we'll go into the ramifications of that momentarily as well. So, Kim, not to get too far off, but I want to make sure we're addressing the questions. Yeah.
So, quick question for you, because a question did come in. Do you want to take it now, or you want to wait until the end?
Let's hold up on if we can go with this one here is, what could be the negative consequences behind filing for forbearance? Ooh, that's a good one. I had a couple of debates online with people, with consumers that are reading different things online. Guidelines are tricky because guidelines give you a rough perspective. Mortgage guidelines give you a rough perspective of what you can and can't do. But if you're really outside the industry, it's really hard to interpret exactly what's doable. So the first thing is the CARE Act stipulates there's not to be a negative reporting on the credit report for people who go into forbearance as a result of COVID-19. Here's the caveat. There's nothing stating that the lender can't mark a comment on the credit report that the loan is in forbearance. We saw tons of people during the real estate crisis go into forbearance thinking it's not going to have an impact on the credit report. And until the loan is current, the lender can still report the comments in forbearance. And if you speak to people who do credit repair, those are the hardest comments to get off of a credit report. Now, what's the impact? By even if they don't report you late, but you have in forbearance marked on your credit report, people are seeing drops from doing a forbearance in March. April people saw drops as high as 50, 60 points, 80 points we're seeing that people are losing in their FICO scores as a result of the comments in forbearance. To give you an example how they work, the same way that a loan or debt that you pay off that's settled for less than the amount owed, that is charged against your credit score in a much more harsh way than paying the debt in full. Not equal. So the issue you have to look, or the consideration there, is if you do a forbearance, how are they going to report to the credit bureau? Are they going to report in forbearance? How is that going to affect your credit score and affect your ability to get credit in other ways? Sometimes what people miss is if you're paying higher interest rates on everything else because your credit gets worse, you may not be winning by saving money in one area. So that's the first, the credit report. The second is, once you go into a forbearance, the money that you basically put in the rear of the loan is typically placed there in the form of a second mortgage, the same way they are when loan modifications are done, where the money's put in the rears of the loan. Here's the challenge. If you ever want to refinance, take money out your house, take advantage of lower interest rates, that will have to be paid first before being able to take advantage of other options as far as mortgages or saving. So that is a catch-22. A lot of people don't know these things going in because the fine print is not really what people pay attention to. Just like we talk about down payment assistance, there's a secondary lien in many cases that prevents refinancing, that prevents doing anything as far as taking equity out, taking cash out the house. That forbearance carries, one, the possibility of impact on the credit score, and two, if no impact on the credit score, definitely the possibility of a lien, or the likelihood, I'd probably say 90, 95% of the time, it's going to be a lien, a second lien that the lender's placing there to make sure they get their money on the back end when the loan is paid off or before you tap into your equity. So those are the drawbacks of the forbearance.
So let me ask you this, because I've heard, not my clients, but just people that are homeowners or even renters say that they've heard that whatever you don't pay, so let's say you're in forbearance for 3 months, that they just add those 3 months to the end of the loan. So if you had a 30-year mortgage and you were already 1 year in of paying it, so 29 years left, they're just going to add 3 months. So now you have 29 years and 3 months. Would you say that that is accurate as well?
Partially accurate. The challenge becomes if you're looking to pay the loan off or you're looking to refinance. The issue people have is if you have your money invested with someone, say if you have $300,000 invested, what people miss is the government's not loaning their money. Investors have their money tied up in mortgages. So when you tell a person, just like if you have $100,000 and you put into the market, you're not going to want to hear your money didn't earn anything for those 3 months. You have to wait 30 years to get it. So how they secure the investment is banking on the probability that the consumer is going to want to do something to change their mortgage in the next 6 to 8 years, maybe sooner. So they attach that second lien there for the negative amount. Even if they're allowing you to continue the payment schedule, they're attaching the second lien there because there's also this thing called a mortgage note that you're originally signing stating that you're going to pay the loan through month 1 through month 360 or whatever the term is. So hypothetically, if that money is not being charged interest and accruing, because they're saying it's not accruing additional interest, it has to be placed in a static position so that money is not being racked interest on month after month. You're not paying interest, compounded interest on interest. So that's why a second lien is placed there. So yes, you're adding years on your loan, but if you ever decide to pay off the loan, the entire balance of that forbearance has to be added. So let's look at it. If the average mortgage payment is $1,500 and a person took 6 months, so you're looking at what, $6,000, you're looking at $9,000 on top of the payoff that has to be paid if they decided to refinance, take cash out. So you have to really ask if you can afford to pay your mortgage. We know about time value of money, but I can't say it's a smart move strategically.
Gotcha. Okay.
Yeah, because what you could miss.
Okay.
All right. So the next question is, should I stop making my mortgage payments? I'll say that if you've been impacted, if your income hasn't been impacted, we're not talking about if you just have cabin fever and you're shopping too much online because you're home. If you cannot make your mortgage payment because financially you're not in a position to, because either your job is stopped, your income has been drastically reduced, I recommend you continue to make your payments if you can. Because just like what occurred in 2009, everyone went negative hoping to modify their mortgages. For the people who continue to pay on time, they came out with a program that would allow HARP to allow people to get lower interest rates and reduce the negative equity on their mortgage, providing they had a good credit standing and their credit met the actual criteria of the time. So historically, whenever there's a there's a massive collapse in the market or there's a failure, historically there's been some type of bailout for the people who keep the system together. You have to think about it. It wouldn't make sense to reward people who could potentially be abusing the system and not reward or incentivize the people to continue paying. So we are hearing a lot about programs coming. And I think that's the reason that the Fed is dropping the rates. Not that it impacts mortgage rates directly, but we believe mortgage rates are going to follow shortly after the pandemic and people are past the forbearance period. I'm almost certain there's going to be opportunity to really take advantage of lower rates than we might even be seeing right now.
So for those who are saying, well, I can afford it right now, but we don't know what's going to happen in the future. So is it best for them to do the forbearance or work something out so that they have more cash on hand because of the uncertainty of what's just happening in life? So not even just the real estate market, but everything going on because they need more of the cash? Or is it best to pay the mortgage now, what they can, and then kind of worry about what may happen as it comes?
I think they should pay the mortgage because you have another possibility, which is you don't know where you're going to be as far as an equity position. So it's always advisable to pay your loan down as much as possible, just from a standpoint of having an exit strategy, having equity in the property if you really need to tap into it. So your equity should be a nest egg. It's not just to tap into because it's convenient. But the other side is if the concern is saving money, most people are paying a higher interest rate and have loan terms that are worse than they could get in the market now. why not look at a refinance option where you could potentially save or have 2 months without a mortgage payment, maybe even get cash back and work through the pandemic if you're still working and save money long term, not a temporary short fix. I think the forbearance is a Band-Aid. And I think what most people are looking for is the ability to maximize savings in the value of their dollar. Yeah. So if that answers the mortgage question, I think people want to get onto the selling. We don't want to stay on this section too long. I think I've been on here 20 minutes. So let's get into the other side, which is selling property during COVID-19. I'd love to hear about the real estate side, what you're seeing and stuff like that. So the first question is, can you sell a tenant occupied property? Let's say if you're a landlord during a pandemic. If so, what are the restrictions, Kim?
So you can sell it. And I can say sometimes it can get complicated because you're selling for a reason. Either you're trying to move, you need equity, or you're upside down. Like there's a reason most people are trying to sell, especially if they're selling in a pandemic. And I've run into some situations where tenants are very amicable to the idea. And then I've had certain situations where the tenant, rightfully so, has concerns. So they're like, well, who's going to be coming in and out? How can I ensure that people are not touching my things? You know, what is going to happen? Can you wait until after I leave in order to list this property? So the answer is yes. But it takes a very astute realtor to work with all parties to make sure as many needs are being met as possible. So everything won't be perfect, but it does take some communication on all sides and the ability to be flexible. So for instance, I currently have a client that I'm working with and the tenant has small children. And she has concerns that people are going to be in and out of her house. She wants to wait until her lease is up in order for the property to be listed. So what I did was I heard what the seller was saying that she needed to sell immediately. And I asked the tenant, you know, what if I set up a sanitation station? You know, what if we made sure that prior to every appointment that we were asking if anybody had any flu-like symptoms, have they or any family members contracted the coronavirus, if we made sure that they had masks that I would supply, that they had gloves, that they had wipes, that they had hand sanitizer, that we would leave closet doors open, that we would leave windows open, that we would leave the house as open as possible so that when guests come in or future home buyers come in, that they're not actually touching any of the personal belongings of the tenant. And so that has seemed to work. That seemed like a good middle ground. And it really just does depend. So the CDC says that an agent is essential. So well, the CDC didn't say that per se, but for the state of Maryland, real estate is an essential function. It's an essential part of the community. It's a commodity in which keeps the government flowing because taxes are one of the things that are paid when you buy and sell real estate. So the government wants to make sure that taxes are getting paid. So we are essential. So we are in the state of Maryland able to go out into the community and show houses and sell houses. But the CDC also recommends that we not have clients in our vehicles, that we are staying 6 feet away from our clients, that children do not come on showing appointments, that only the buyers, so not friends, not cousins, not moms and dads, that only the people that will actually be signing a contract will be the individuals that will be present in the showing. They've also requested in the state of Maryland, we must wear masks. So that is something that is required. I have a mask. I don't show a house without a mask. Even my rental properties, if you want to see a rental, you must wear a mask in order to have access to the property. So those are just some things. We've had a lot of changes. That includes virtual tours. Virtual tours are now big. So I work with a private company, Wire and Designs, in order to create virtual tours for my clients. That way, a client can have the experience of being there without taking the risk of going out if they don't like the house in advance. It gives an opportunity for there to be a preview. It also cuts down on a lot of foot traffic in a home, but it's just another option to get eyes on a property so that it can be sold. So that's a big thing now is our virtual tours. Appraisals have changed. So previously an appraiser would come into the property, look at it, check some things out. They would also do an exterior view of the home. Now they're doing, I call it California style, they're doing drive-by appraisals. So they're only doing visual exterior views of the home and then providing a value that way instead of actually going in the home as previously was done. Our closings, which usually happen at the title company or on the title company level, they're now virtual as well, and or very minimalized, meaning only the title company or the settlement agent and the client are present. So I always like to be present for my clients at settlement. We love to take pictures. We love to celebrate. I love giving gifts. A lot of that is happening virtually. My gifts are being sent to their new house. Sometimes title companies are actually having video chats, such as what we're having right now, in order to connect with their clients, in order to have documents signed. Notaries used to have to go into a bank or meet in person with the notary, and now there is some authorization for there to be virtual notarization. So there's been so many changes, and we're just trying to keep up with it day by day. I'm thankful that I'm a millennial, so a lot of this is easy for me to include digital signatures for my clients, so we don't meet in person to do signatures. But as long as a client is flexible and all parties are flexible, it pretty much is a seamless process. I just closed on a VA loan last week, and we were closed in 28 days from start to finish and had no hiccups. So for those that think that it's not possible, definitely possible. It's absolutely a seller's market. And a seller's market means there are more buyers than there are houses available. So my last 5 transactions were pretty much what they call multiple offer situations. I've had that happen with one client 5 times. And each time there was at least 5 to 12 other offers. So there are people looking to not only purchase homes, but there are individuals that feel confident enough and comfortable enough to be able to sell their home during this time as well. So yeah. Oh, and the inspections, how can I forget that? So inspections, it used to be the inspector, the realtor, and the buyer. And now 95% of inspections are all virtual, and they are contactless. So that means that neither the buyer nor an agent nor the seller nor the seller's agent can be present. The inspector is going into the home and inspecting it by himself and either doing a live feed or doing some recordings and then doing a live or a follow-up telephone call with the buyers to let them know what they found in the home. If the home is occupied, then the individuals will have to leave the home. There are some inspectors that say that the residents can stay within the home. However, if they don't stay within a particular area, they will then have to be quarantined. So it depends on the inspector, but there have just been little changes. It all depends. It's a case-by-case basis, but definitely I have found that even in my experience recently, that it's definitely a time to sell for those who are open and willing to do so. I can't hear you. Can you hear me? Quay, I can't hear you if you can hear me. I can't hear you. Okay. All right. Yeah. So if you can hear me, I can't hear you, but I do see the question on the screen. And so I will answer that question, and then maybe we can kind of go from there with the audio. So it says, what happens if a buyer is impacted by COVID-19 in the middle of a transaction? So I do think actually that's a question that both you and I would need to answer. I did actually have that happen to me. Everything happens to me last week, clearly, but that did happen to me. I did have actually 2 clients. One was a buyer and one was a seller. that were impacted directly by COVID-19 and more financing wise. So the buyer had a change because of the changes with the credit score with his financial institution. It caused him to not be eligible for the particular loan product that he was currently using in order to purchase the home.
Got it.
And therefore, for that reason, thankfully, they were able to put him into another loan program that fit his credit score. However, the seller was not willing to move forward. We had already met the contract deadline and they did not want to extend. So that is an instance of what can happen. However, should the seller have wanted to move forward with continuing the contract, that could have happened. So that was one scenario. I did have a client that had work hours cut, and so therefore income changed as well. And therefore she was no longer income qualified. Her debt to income ratio was too high. And so she was no longer able to move forward with the process. Thankfully, I was in communication with all parties for both of those clients, all parties at all times to let them know, listen, this is what is happening. We don't know what's the next steps. You know, if our lender is going to say this, or you know, he will be able to get into this loan program, but if you can bear with us, so that when we did get to the point where we were at an impasse, we were able to move forward for one step, but in the other hand, we were not able to. And so we had to, you know, complete a mutual agreement in order to rescind the contract or to end the contract, which does happen. So as much as I'd like to say I close every deal that comes my way, you know, life happens, things happen. And so we just have to learn to roll with the punches. And it is what
all
it
right.
is.
So we're still moving and shaking. Now is still a good time to buy, sell. So now we want to get down, go to the Q&A section. People have been asking questions. We want to make sure we get a chance. Let me address some of the live questions first, if I can, Kim. The first was from Deborah King. What if you were approved and about to go to settlement, then your job files for bankruptcy? What did you do? Should you do a refinance with another mortgage? Yes, you could try to do that, but I have to tell you, first of all, you have to be employed. Fannie Mae and Freddie Mac and HUD released a document about basically the requirements to verify income because of the unemployment rate because of COVID-19. So okay. Yes, we can talk about that. I would suggest you inbox me or contact me at kparker on Facebook, or I'll post my phone number in the comment section. You can give me a call directly, and I can give you some guidance on how to do that. The bottom line is we have to verify employment because of the new laws regarding the predatory lending that were passed during the mortgage crisis. We must verify a means test to make sure that you have the ability to repay the loan. So if you're out of work at this time, or if a person is out of work at this time, they would have to be able to verify a source of employment in order to close even on a refinance or purchase. So give me a call directly, but the answer may not be another lender. We can try it. We can give you some guidance, but that may not be the answer. All right. The next question we had is, I guess they had two of the same questions. Kim, you had a question, didn't you? Someone sent a question over to you? So
yes, it says, my mortgage company contacted me for a streamline, taking my rate from 3.75 to 2.75. I accepted it because it lowered my payment by $115 a month. Was this okay?
It's already done?
Let's say presumably no.
Streamline is just a program for doing a loan where you don't have to requalify. It doesn't mean there are no costs involved. If you're questioning it, I would get a second opinion to see if it makes sense. There are two sides to it. The first is the cost versus the savings. It sounds good just looking at rate, but I've seen people drop, 0.75 or 1%. They paid $6,000-$7,000 to save $40. So the question becomes cost versus reward, and how long does it take to recover that money that you're investing, if any, into lowering your interest rate. So it's not a blanket answer. I wish I could give one, but I'd love to give you a second look. I can have one of my loan officers take a look at it and tell you exactly what your other options are. And you can do that by contacting us directly at Equity One Lending. And if you don't, I'll throw my phone number up. It's 443-961-2500, and someone will be happy to help you.
Okay. So what do you do in cases in which someone may have an investment property and the tenant is behind on the rent?
If the tenant is behind,
okay, yeah.
Here's the challenge. Investment properties require reserve. The owners have to have reserve money. You cannot be banking on rent to cover the mortgage payment 100% of the time. Vacancies and non-payments are a reality of the game. So the solution would be to first find out what kind of loan you have. If you have a Freddie Mac or Fannie Mae loan or FHA loan on the investment property, somehow you have an FHA, maybe it was a primary residence first, and you turned it into an investment property. A forbearance may be your best option if you do not have the cash to maintain it. By far, the forbearance beats a late payment or multiple lates. But if you have other options, I'd recommend you look at those. Even refinancing, if you're still working, you have the income to qualify.
So you mentioned earlier about the comment. How can a comment cause the decrease in a credit score? So you mentioned that a credit score can drop 50 to 60 points because of a comment that a lender left on a credit report.
Yes.
So how is that so?
They're classifications, just like delinquent, in collection, forbearance, paid for less than the agreed amount, or paid for a lesser amount than the amount owed. All of these things are factored in the FICO scores to impact it adversely. You have to remember the scores are designed to basically tell creditors what type of risk you are as a credit risk. So where there's not always a way to indicate, every situation does not fall in the category of 30, 60, 90, 120, or charge off. Certain things have to be noted, but they do give you information as far as on the person's credibility. So overall, that's why the comments are there. For example, if you're, a lot of people miss this, if you have student loans that are deferred, the student loans that are deferred are marked deferred to tell creditors, hey, the payment says 0, but this is a liability that's coming due. It impacts the credit rating. It impacts the credit decisions. So that would be the quick answer. If we could go really deep into it, but that would be a whole hour session by itself, how comments affect credit reports.
Gotcha. Can you talk a little bit more about the finance piece? So who is refinancing not for? So I know that, different people are in different situations. We have some people whose jobs are temporarily closed.
Yes.
We have those that are receiving unemployment, and the unemployment is going to be available for the next, let's say, 6 to 10 months, according to whatever information they receive. So is refinancing only for those who are gainfully employed at this point, or who is it not for? That might be easier as well.
Refinancing is for anyone, and I have to answer that question in a compliant way. It's for people who can, if I haven't done this already, NMLS number 49165. Refinancing is for people who, yes, have a income that can be verified and that they can justify their ability to repay. I don't want to say that if you're out of work, you can't qualify, because we also can't discriminate on the source of income in determining a person's credit eligibility. So that's a thin line that we don't want to, cross. I would say that if you currently feel that you want to see if there's an option to refinance versus forbearance, or refinance is to take advantage of lower rates, what we do, which is unique, is we allow a soft pull, so we can give you an opinion without you having a credit inquiry that impacts your credit score. So that's a no risk way to really get a feel for if it's going to make sense, because there's two sides to it. It's, can you qualify? But the second is, does it make sense? Like we just talked about, versus what it's going to cost versus what you're going to save and how long it's going to take to recoup that. Sometimes it's just not worth it, and we'll tell you that. So I would say that the only way to answer that is to just have a conversation with the lender like us, Equity One, and we do a soft pull, which I think less than 5% of lenders do soft pulls. Most people do hard inquiries, and that's the only way they do it. We do a soft pull to give you an idea where you are, and that way your credit doesn't get damaged if you determine it's not for you at this time.
Gotcha. So you mentioned before, see, I like cash back, so I heard that. But you mentioned that with refinancing, there may be the option for cash back. How does that work?
Oh, it's a cash out. You could, if you have equity in your property, you can get money back to consolidate bills, eliminate debt. We're doing a loan right now where a person's income was reduced because of COVID. They lost their part-time job. So now it's a struggle. So the solution was to take all her bills and consolidate the bills, or their bills, and consolidate the bills, the credit cards into one bill, and they save like $1,200 a month. So now they're able to save money long-term, and they're able to get through this crisis. So a lot of ways to do that. We're really creative at finding ways to look at a picture and figure out ways to cut the monthly expenses, because that's really the goal, is really to limit the monthly overhead.
Gotcha. Okay, so this is an interesting question. Not sure if we can answer it, but we shall see. So assuming there is a situation in which either the person that is carrying the note is deceased due to COVID, how does one then move forward, either as someone who is co-borrower on the loan, and or let's just say, is a relative of theirs? How does one move forward with either refinancing or selling a property for someone who is passed due to COVID-19?
See, that's a borderline estate question, because there are multiple considerations. It's how the property is titled. If the property is titled joint tenants, where they have survivor benefits, where the other party becomes 100% owner, there would be no impact. But the question becomes how it's titled. And that would be a question that would have to be case by case by a title attorney. There's no blanket answer, because it could be a situation where it has to be an estate opened. It could be a scenario where they're tenants in common, where they only have 50% of the equity, and the 50% has the ability to, or should I say, I don't want to use the exact deeding. I'm not an attorney, I stress this, where the other party's heirs have right to their part of the house. You have to speak with the title attorney to get clarity on exactly how that will work. I wouldn't want to give them a blanket answer. That's one where they definitely want to talk to an attorney to make sure that their legal rights, that they're within their rights and whatever they're doing.
Gotcha. And last question, is it ever possible for someone to use the refinance process to maybe add someone to the mortgage?
Actually, that's an interesting one. You can actually use the process of either a traditional refinance or what we call rate reduction, where the bank pays all the costs associated with lowering your interest rate on FHA or VA transactions. You can use either one to take people off or add someone. A common scenario is people were recently married. They want to add a person to the title, maybe. We can do that at the time of the transaction. Or a divorce scenario where you want to remove a person. There are a lot of options there. And this is what a lot of people miss. In the case of a domestic split, a divorce, there are ways to switch the mortgage over that are not bound and pay the other party off, that are not bound by the traditional cash out restrictions. So there are a lot of options there. If you have to take a person off in case of death or divorce, yes, there's some options there that are really interesting that I've literally listened to lenders and banks tell people they couldn't do because they don't understand the guidelines, and we were able to do the refinances and pay off the other parties where they were told no elsewhere. So there are a lot of ways and a lot of loopholes in the guidelines for provisions with deaths and divorces to take the other parties off or add people on.
Gotcha. Okay. And that's all the questions I have over here.
All right. That's good. We're at 45 minutes. I think we did good. This is going to be rerunning again. When we're going to repost this, please share it. Please tell people whenever you see these. If you don't, I want you to follow Kim McBride on Facebook, follow kparker, or should I say follow Equity One Lending on Facebook. And we're going to be posting more episodes and more information when we'll be delivering in the future. I'm going to hand it over to you, Kim. Thanks for having us on here.
Oh, no, thank you so much for the opportunity and just sharing your knowledge. Again, I couldn't do this without you. I definitely want you to leave your information as well. But for those who have real estate questions and are not already working with a realtor, feel free to give me a call. Again, my name is Kim McBride with Apex Realty, 410-961-2742. On Instagram, I'm at getkeyswithkim. My Gmail is getkeyswithkim@gmail.com. And you can also find me on Facebook, LinkedIn, YouTube, all at Get Keys with Kim. Quay?
All right. And I'm Quay Parker with Equity One Lending. You can reach us at 443-961-2500, online at Equity One, spelled out, equityonelending.com, and on all social media at equityonelending.com or Equity One Lending. Yes, so that's the information for us. All right.
Awesome. Thanks so much. Have a good evening, everyone.
Thanks for tuning in, everyone. Have a good evening. Be safe. Stay inside.